Hello and welcome. In today's video, I'm going to review the Cday ETF from Hamilton. I recently purchased a substantial chunk of this ETF, making it about 7% of my total portfolio. The reason for this was quite simple. The structure of this ETF is designed to maximize both income and capital gains. At the same time, its holdings have low volatility compared to the broader market. This is quite rare for an ETF which is paying an annual yield of over 15%. Most of the time, high yielding ETFs depend on high volatility stocks. But that is not the case with CDAY. Last but not the least, I think the specific mix of stocks within CDAY make it the better overall ETF within the DayMax series. In this video, I will mainly focus on two things. First, what makes CDAY better than similar ETFs that offer a high yield of over 15%? And second, what makes CDAY better than the other two DayMax ETF, SDAY and Qday? First, let us take a look at the structure of this ETF. Like most high yield covered call ETFs, it uses a 25% leverage, but the way it allocates this leverage is very interesting. Out of 125%, 100% gets allocated to CMVP, which tracks the Solactive Canadian Dividend Elite Champions Index, while the remaining 25% is allocated to VOO, which is the S&P 500 index tracking ETF. This structure of allocating the leveraged portion to a different holding is known as stacking. The best example of this form of structure is the ETF with ticker symbol BTGD. It is the stacked 100% Bitcoin, 100% gold ETF. This ETF uses 100% leverage, which means for every dollar invested, you're getting $2 worth of exposure to its underlying holdings. Under normal circumstances, this would make it a very risky ETF due to a phenomenon called volatility drag, which is typical for highly leveraged ETFs. For example, if a stock drops by 10% on a given day, the leveraged version of the stock would drop by 20%. However, if the stock recovers that 10% loss the following day, the leveraged version will only recover by around 16 to 17% and end up underperforming the underlying holding. In general, highly leveraged stocks often end up underperforming their underlying holding in the long term. But with an ETF structure like BTGD, where you're actually tracking two different underlying stocks, you're getting 100% return of those two holdings while at the same time leveraging your overall investment. This is the advantage of allocating the leveraged portion to a different holding. If we look at CDAY, this is exactly what they are doing. For every dollar invested in CDAY, we are receiving $1 worth of investment in CMVP and then an additional 25 cents worth of investment in VOO, where they write the 0 days to expiry covered calls to generate income. This becomes particularly important during market downturns. In a typical covered call ETF, both the primary portion as well as the leveraged portion will behave the same way as its overall underlying holding. But in case of CDAY, the primary portion, which is 100% CMVP, will behave differently from the leveraged portion, which is 25% VOO. Similar to BTGD, CDAY is able to avoid volatility drag by allocating the leveraged portion to a different holding. This ability to avoid volatility drag is what makes CDAY better than your typical covered call ETF with 25% leverage. Now let us take a look at specific holdings within CDAY and why I think they are better than SDAY and QDAY. The holdings of CDAY are arguably better than those of SDAY and QDAY. To understand this, we need to take a closer look at the specific holdings of each of these three ETFs. CDAY holds CMVP and VOO. SDAY holds SMVP and VOO, whereas QDAY holds QMVP and QQQM. VOO and QQQM track the classic S&P 500 and Nasdaq 100 indexes, respectively. Given how well known these indexes are, there is no need for me to provide any further explanation about them. But these other three holdings, CMVP, SMVP, and QMVP, are based on proprietary indexes created by Hamilton through the German index engineering firm Solactive. Let us get a better understanding of how they work. CMVP is based on the Solactive Canada Dividend Elite Champions Index. Based on the description on Solactive's website, it is designed to provide exposure to an equally weighted, high conviction portfolio of equities with a proven history of stable and growing dividend payments, while ensuring adequate diversification across sectors. The keywords here are proven history of stable and growing dividend payment and diversification across sectors. In other words, this index aims for sector diversification while aiming for stocks that keep increasing their dividends over time. If we look at SMVP, it is based on the Solactive United States Dividend Elite Champions Index and has a similar description to the Canadian Dividend Elite Champions Index. One thing it does not mention is sector diversification. However, if we look at its holdings on the Hamilton website, we can see that there is ample sector diversification. So, in short, we can think of SMVP as simply a US based version of CMVP. QMVP, on the other hand, is quite different. This is based on the Solactive Hamilton Champions US Technology Index. This index selects the top 25 US based companies in the technology sector. The criteria is gross profitability, and weightage is capped at 6% and floored at 2%. So I'm assuming companies with higher gross profitability will receive higher weightage. We can clearly see why Qday is the riskiest investment within the DayMax series. Both CMVP and SMVP are tracking dividend paying stocks that are expected to increase their dividends over time. This means that part of the income paid out by Cday and Sday comes from these dividends. In Qday, most of its holdings do not pay any dividend, so almost all the heavy lifting for its income is done by covered call writing. This means they need to be more aggressive with their covered call writing in Qday as opposed to Cday and Sday. But the picture looks even better for Cday when we look at diversification. CMVP holds Canadian listed stocks while VOO is a US based index. Thus, there is 0% overlap in their holdings. But that is not the case with SDay and QDay. VOO contains all the stocks in SMVP, and similarly, QQQM contains all the stocks within QMVP. In essence, there is 100% overlap within the holdings of SDay and QDay. If we go back to the concept of stacking mentioned earlier in this video, it only works if the leveraged portion is completely different from the primary holding. SDay and QDay, unfortunately, are not able to capitalize on that aspect. Both holdings within SDay will perform more or less similar during bullish and bearish markets, and that is also true for QDay. Whereas with Cday, its two holdings are more likely to perform differently depending on the market conditions. Last but not the least, Cday has one major advantage over Sday. The holdings within CMVP have a lower average PE ratio compared to SMVP. This despite the fact that both indexes are tracking well established profitable companies with a history of increasing their dividend over time. I think this mainly happens because people are more inclined to invest in the S&P 500 index, so the stocks listed on the US market simply end up having a higher valuation. Regardless of why it happens, I would feel more comfortable buying an investment with a lower price to earnings multiple because the downside risk is minimal during a bearish market. I cannot end this video without addressing the elephant in the room. All three ETFs use 0 days to expiry options to generate income. This is one of those strategies that works well 99% of the time, but that one day when it fails, it could result in significant losses. Essentially, the covered call is written on a daily basis, expiring the same day. In Cday and Sday, it is written on VOO, and in Qday, it is written on QQQM. Just in case on a random day, if either VOO or QQQM goes up by 5% or more, it could easily wipe out the entire income generated during that month. Thankfully, there is no covered call writing on the primary holdings within these ETFs, so the capital gains from them would offset some of these losses, but it might still result in underperformance in the near term. This is an extra layer of risk which these ETFs carry over a regular covered call ETF where the options are written on a monthly basis. So, this is something we need to take into consideration. And with that, we have come to the end of this video. Let me know if you already hold C Day, S Day, or Q Day, or are planning to buy, and what is your opinion about these ETFs. As always, the information presented in this video is based on my research, represents my opinion, and does not qualify as investment advice. Always do your own due diligence before making any investment decisions. If you found some value in this video, don't forget to like, share, and subscribe. I will see you in the next one.